reading the markets right now? Is this a good market where you should get greedy, or right now it's time not to get greedy and accept that volatility is back?
Morning, Nikunj. Good to be with you after a while. I think the market right now is one where you have to protect your skin. And we've seen a lot of issues over the last 45 days, 60 days, and people who have survived that should actually be not on the back foot really in that sense, but you cannot be adventurous in this kind of a market, especially with 6 months to go for the election, and especially looking at the kind of the nature in which the market was breaking in October. So I'm not saying we're going to go there again. I think the worst is behind. But I don't think that the market is going to do any heroics or give us anything on a platter right now, at least for the next 4, 5, 6 months till the elections are there.
Basant, I'm just going through your notes. Morning, firstly. You believe that the best and the worst of the market is behind us. I understand that the worst is behind, given how crude markets have behaved. But why the best? Do you not believe that we're likely to see those previous highs again, or for that matter, even build on them further?
Morning, Aisha. I think two things. First, the best is contingent on who comes to power in May next year. I think the present government would be re-voted back. But before that, I don't see any magic happening. Globally, our problem is when US does very well, nobody wants to invest in India. And when US doesn't do well, we say, oh, there's a global slowdown. So we have to actually pray to God that the US does only so well and not very well or not very badly. It's quite a complicated thing. And I think on a side note, you should invite Donald Trump to one of your shows. I think he's the best guy to tell you what's about the best and the worst. I mean, he handles the entire global market capitalization through the Twitter account. I mean, it's become so difficult for anybody to take a guess as to what's going to happen. But on a serious note, I think good companies, back to the ones which we always talk about, which is always in the domain of discussion, fundamentally strong ones growing at 30%, 25%, they will do well. But that's only a handful of them. There's just 15, 20, 25, 30 companies in India that do that kind of work, and they're not cheap. So except for that, I think it's going to be tough.
On your point of inviting Donald Trump, we don't really need to, because he makes our job so easy, right? Every morning there are some 3-4 tweets by him. So no need really to get him here in person. But yeah, if he agrees, I'm sure we'd love to have him in the studios.
Who wouldn't, right? No, but well said on that. That's true. I think his comments are very well known. But Basant, you brought up an interesting angle, and that's about the risk of elections coming into 2019. How should one prepare their portfolio for the volatility that may come by on that front? So I'm adding some other factors. There's some global headwinds as well that we are facing. What happened on Wall Street last night has not impacted us thus far, but if you have successive days of significant sell-offs in the US, at some point in time, one would wake up and wonder that maybe this would spill over into Asia too. The outlook on rates, what's happening with oil prices, all of these factors would only increase the risk and probability of volatility into 2019. And so how does one prepare for that?
I mean, the market is already preparing for that. I mean, a stock like a Hindustan Unilever goes and hits an all-time high. Consumer names are doing well. The FMCG standard names are doing well. So the market is telling you, I mean, the private banks are again coming back in the vogue. So the market is telling you that people want to invest, but they want to be invested in areas where there is a lesser risk of capital erosion. And because 80% of the money always remains in the stock market, it is the incremental 20% that creates a bull phase and a bear phase. So I think that 80% is now deciding to switch into the stronger names and the more stable names. Of course, they are not the fancy ones where you can say this one is going to do well or grow at 40% or it looks cheap on a DCF basis. But that's about it. I think the writing on the wall right now looks to be consumer, FMCG, high pedigree, expensive stocks, but at least where you can, after 6 months, say, okay, I put in 100, at least I'm still left with 95, 97, whatever. So I think that's the trend. And the trend to create real magic is not now, not especially in the last year of the elections, not when there is a global I mean, there are so many things moving. The Fed suddenly says we will pause with rates. I think there's one trigger which the RBI can do. That is if they cut the CRR today. The crude is down. We are okay on dollar. The Fed has indicated that it might not be so aggressive in raising rates. So what stops the RBI from cutting down rates? I mean, your inflation is falling. So we need not be textbook oriented all the time. There's a time to think out of the box and out of the book. I think that's the time right now.
You know, when it comes to a market association, you have a strong association with NBFCs. Even though I don't want to talk about NBFCs, but if you are on the show, I'm forced to relook at NBFCs. Now, every NBFC is not bad and every NBFC is not good. I think that is a realization which has come to us in last 2-3 months, that NBFC needs to be differentiated. What end of the NBFC market you still own, what end of the NBFC market you don't own. And I just want to give a backdrop to our viewers here. Historically, you've owned HFCs largely and you've also owned retail dominated NBFCs. So let's take it forward.
Because we own the top-notch NBFC in India and we own it for a long time now. So that's still above the January level, above the March level. That's down 15% from the top. And we bought lots of it when the markets were cracking. Actually, we own just 2 NBFCs, and one of them is Bajaj Finance, which, I mean, I can tell you is not a recommendation, but we own it till our neck. And we think this is going to capture market share over the next 3-4 years. So you can be bullish on NBFCs, you can be bullish on private banks, but you don't have to own all the NBFCs. And when a situation like this comes up, the leader gains market share because the raw material for the second line and the third line players wouldn't be coming, and the raw material for these guys is the cash that they borrow. So even if the raw material comes, the yield on that raw material would be 10%, 9.8, 10.2. So obviously the economics wouldn't work in their favor. So I think we are fine with what we own in the NBFC space. And as you know, we don't own too many companies even altogether. So that's what we have.